Next up, we've got risk management of tactical trading managers. It looks like Neil Berger's been having internet issues today. He is, I feel for him. He's working from home in Barbados during quarantine, you know, and sometimes when you're on an island, there are internet issues. So we're trying to get him on. But if not, we are going to go ahead with three, dare I call them, industry luminaries. Peter Bremberg, COO at Booth Bay Fund Management. We got Markian Zyga from Lighthouse Partners, and my buddy, John Culbertson, CIO, Context Capital Partners. Gentlemen, you want to take it away? Actually, I guess, Peter, are you able to kind of guide us here with Neil out, or do you need a little help?
Yeah, I'll probably ask for you to tag in, James. If that's
okay. Right. So I'm going to delay finishing the donuts.
But I'll start thinking of some moderator questions now that 10 seconds ago you said that I should be leading the ship. So the brain's
well, you know what? It's live TV. Things happen. I'm going to stay here. Pretend I'm Neil. Pretend that I'm in Barbados, and pretend that I'm asking you, what risk metrics do you run? And are they ever at odds with the risk metrics your tactical traders or use or emphasize in their individual books?
Sure. Want me to start off? No problem.
Yeah, start off, Peter.
Yeah, thanks for having me on. Good to see you, James, and good to see fellow panelists. I guess the 20-second background on Booth Bay and our perspective is we're a multi-manager platform through managed accounts. So we have about 110 managers who trade on behalf of our two funds, and we allocate capital and manage risk across a pretty wide set of liquid strategies and some quasi-liquid, but we don't really do much in things that are private or really illiquid. So in terms of risk and how we think about it, I'll focus less on kind of how we think of it as an overall portfolio, but at the manager level, we try to customize quite a bit with our managers based upon the strategy they trade, which sounds obvious, but some of the feedback we hear from managers and what we understand versus other platforms is, certain, if you think of, I guess, multi-PM platforms, a lot of them, because of scale, it's hard to, sometimes things have to be one size fits all. That's at least what we, our perspective versus how we do it. So what we try to do is hear how a manager really manages risk from their perspective first, and like, what do they look out for? What are they thinking of? Kind of start from the mindset of we've probably got a fair amount to learn from them. If their strategy is especially something a little bit more unique, and which we love unique strategies, new asset classes, new kind of niche type of strategies. But then we try to fit in our overall framework, and our overall framework thinks, some of the, obvious ones, but I'll get out of the way of what's your kind of beta exposure to, whether it's an equity market or a fixed income market, or if you're trading crypto, we do, on the other end of the spectrum, things a little bit more volatile as well. How are you taking exposure to other, market risks and different factor risks? So that's kind of the most obvious one, that there has to be a meeting of the minds, I think, early on with the manager. And if there's a meeting of the minds, it's then discussing how do you set limits that work, hopefully, let's say 85% of the time. We'd rather something, work most of the time, but we understand maybe there's going to be exceptions, and we would just rather not always have the limits be set for the exceptions. And so we always encourage our managers to kind of raise their hand or pound the table when they see something special, and we love to kind of make those exceptions. Those are a lot more fun than when it's the other way, where someone has breached something. But yeah, I mean, that is kind of a bedrock one for us, because it also feeds into correlation. Just given, factors and betas tend to be pretty correlated. And so the concentration and liquidity are the two others that we care a lot about. Not going to, those are kind of self-explanatory, but obviously there's nuances there depending on the asset class that's getting traded. And then the other is, and I think this fits into tactical trading, more kind of ARB type managers or strategies, basis risk, because we're not afraid of things like, notional exposure or gross leverage, because leverage isn't all created equal. And so, however, once you get to certain levels of leverage, obviously basis risk really matters. And so we try to really be thoughtful about, if a manager is hedged to a specific name, a more interesting one, other than, let's say, share class ARB or ADR or kind of a classic, type of hedge strategy or futures basis trades, where it's been a little more fun has been in crypto land. And so just this whole idea of like counterparty risk really mattering a lot when you're, let's say, coin neutral, but across two different counterparties, and counterparty risk matters so much in that space because it's so nascent. And that's where, we apply the same rubric of if you're hedged, but who are you hedged with and what can happen to that hedge? Because again, we tend to be pretty, not too difficult on things like notional, but then that changes when your notional isn't totally fungible. But I'll stop there. Could keep going, but
Peter, that's awesome. And I'll jump in real quick since now I'm on the panel since Neil's not here. So Typhon, I'm the portfolio manager for our MultiManager products, and we think of things pretty similarly, right? So it's like, how do you get to an apples to apples comparison? We've got some managers that are very volatile by design, some that are extremely low margin equity. So for our preference, where we've got full discretion on a portfolio, is to really figure out methods to risk weight the managers on a forward-looking basis. So generally, margin equity in the future space is a great proxy for risk. I mean, we think it's generally better than VAR. CME's span margining system really takes into account a lot of the factors that could happen, even in spread strategies, which are generally thought to be less risky than directional. Spreads can reverse, right? Span takes that into account, right? So we look at any kind of cross correlation we're going to have in managers. Most of our managers are single digit correlated to each other and broader markets, but we've got an ag manager and a livestock manager. There's some cross correlation for that. We've got to put that in the risk budget, when we're trying to balance them out. But so generally we start at historical vol on a daily basis. Monthly vol can hide a lot of sins. And then we add forward-looking risk factors, like, are you positively skewed or negatively skewed? So, what's going to happen in a stress event? Option sellers, we don't do any of them. They're negatively skewed. They tend to grind higher, and then blow up and look like a day in the life of a turkey chart. So we avoid those, but, negative skew is a big thing, we try to prevent against. But I won't go down the entire litany, but let's turn it over to Markian, who manages MultiManager portfolios at Lighthouse, and what are some of the risk metrics you look at and how you implement?
Yeah, no, appreciate it, James, and thanks for having me. Yeah, look, I think across what Peter would have described and what you just would have touched upon, I think there's a lot of similarities as it relates to the things that are important to us. As specifically as I think about our macro fund, and I think that would most accurately fit under the bucket of tactical trading strategies. We have both systematic and discretionary traders in there, and I think there is some level of similarity that we want as it relates to our risk metrics across those things. We don't really rely on any one specific metric, but things that are inclusive across all of our managers are things like net and gross exposure, VAR, liquidity analysis, margin limits, stop losses. But I think, that's the initial layer. Once you get there, really it's monitoring, understanding the daily trading of each one of the managers and what they're doing. And ultimately what we're targeting across all of our books is alpha. And so within the tactical trading space, how do we define alpha? It's really combining our understanding of what the exposures look like, what the trading looks like relative to benchmarks. So what are the prominent principal components traded within the tactical trading space? Is it momentum? Is it reversion? Is it carry? We really want exposure to those types of things. And our manager is actually doing something different. I think in addition to that, scenario analysis is very important. Can't rely upon it, but in terms of defining a range of potential outcomes at the manager level and then in an aggregated portfolio sense as well. I think that also goes hand in hand as it relates to, clearly as we're constructing the portfolios, we're running different multi-period covariance matrices to come up with levels of diversification and expected vol. Can only rely on the historical data so much, but what is important, which is probably more the art than science part of the portfolio construction process, is understanding how the trading overlaps or offsets one another on a daily basis. And that ultimately really is where we gain conviction that some of our managers and PMs that we really like are actually doing something quite unique. I think it is different, across discretionary and systematic approaches. As an example, for systematic, we really spend a lot of time thinking about slippage and execution and, do they actually have edge from a technology perspective? Whereas on the discretionary side, it really is thinking more about trade structuring and, those higher moments, the positive skew that, I think James just would have mentioned. So it's all that stuff together that, really kind of provides a constant feedback loop as it relates to the risk management metrics that really ultimately matter to us.
That's awesome, Mark. And John, could you unmute and let us know if you've got something to add on this topic that we haven't already covered, or if we should move on to the next?
Thank you for having me, James, first of all, and great to meet the other panelists.
I've been trying to get you on here for years, so thanks for finally coming, and instead of just coming to the cocktail party at the end. I know that's the best part, but...
So I come at this question slightly differently. I have a little different perspective. I think the biggest risk for these kinds of strategies isn't really market oriented. It isn't operational. I think it's we think we have an edge and we understand the edge and we know what markets it works in and what markets it doesn't work in. We understand who we're trading with and why we trade with them. And then we find out 2 years later, we're just trading noise. So we take all these other risks, operational, all sorts of other risks, and we don't have any offset to, to benefit from taking those risks. And you find out after the fact. I think if you had the confidence that there really is an edge, then all these other risks are important, but you should really be putting your resources into making sure you understand the edge, that is durable, that it's repeatable, and that you put the effort into researching ways to increase the edge or maintain some sort of competitiveness. So, we all know that, but I think it's easy to deceive ourselves into thinking that we can turn all these knobs and dials and change look-back windows, and the real risk is that the edge is going away. It doesn't go away with a bang usually, it goes away with a whimper. And in this environment, this hyper-competitive environment, I think it's really tough to maintain edge for a long period of time. So having said that, I think about it as there's like a fenced area where the very outside is, I look at historic data for drawdowns, dollar drawdowns, percentage drawdowns, trying to compare apples to apples. And anything outside that data is obviously a huge red flag. So that's like the first high level look. And then it's, from inside, it's all the things you guys said that I think are absolutely true. I am very suspicious of strategies that use data any longer than a couple of years. Because I think the markets are so fundamentally different in the last few years than they are now. And I think you get on thin ice looking back any further than that. And the last thing I'll say is one thing we spend a lot of time thinking about is who we trade with. And especially in the higher frequency stuff that we've backed. And you really have to, I have to get comfortable with understanding who's on the other side of the trade and why. And if the answer is it's 2 Sigma and it's SIG and it's Citadel, and I've got a lot of skepticism that you've really got to trade on your hands. But when it's longer term and there's a reason for someone taking the other side of the trade, it's a little more understandable, a little more justifiable. But my background's more in the systematic quant space, so you can tell I'm sort of tainted in that direction. I just think it's super competitive and really difficult to maintain some sort of competitive advantage there. So I'll stop.
John, that's awesome feedback. Yeah, I mean, the HFT space has gotten just so incredibly competitive. I think you're dead on. Now I see Neil on here. Neil, you're muted. Are you able to weigh in? I know that this is a topic that's near and dear to your heart, so I'd love to see you drop knowledge if that Barbadian internet permits.
Hey guys, I'm so sorry. We have an island-wide outage on internet and phone and TV. TV being the most challenging for me because that's my social life at the moment. But I apologize for. I'm just trying to do this on my iPhone. So I very much agree. I came in a little late, as you know, with the gentleman that just made comments. I mean, we're all about looking for, the real inefficiency and the real edge. And I've heard a little bit of Peter's comments and some comments from the others. I just tell you the way that I think about risk management of these tactical trading strategies. So when we hire a manager or a trader, whatever it may be, we ask that manager, a variety of questions as to where they think their risk lives. In other words, how much do you think you could lose in a worst case scenario on a monthly basis? How much do you think you're going to lose for the year? How much do you think you're going to lose in a day? Whatever. So we're not dictating to them. We're asking them the question, right? And then we're always sort of haircutting it a little bit to say, okay, well, they're probably not, they're probably underestimating how much they can lose. Okay. So, but as long as the risk reward, that they're articulating like, okay, well, we think we're a 40% expectancy, just being hypothetical, annualized, and we believe that, we're all former traders ourselves and all that, and I can lose 10% in a month. Okay, fine. So we're comfortable with that. We understand, and we're looking at liquidity and all the various other aspects of it, and then we say, okay, then it's just about evaluating the manager and the strategy in the context of what the manager has articulated their risk to be, what their historical risk has been on a qualitative on a quantitative basis. Although we're about 80, since I've been trading for 30 years, I mean, we're about 80-20 in terms of qualitative, quantitative analysis. Like a 10-year, obviously, if you have daily performance data, that's more valuable than monthly. But even, let's say, 10 years of daily performance data, is not a statistically relevant sample size. You could be an option seller for the last, barring March of 2020, and have amazing results. But we all know there's a tail factor to that where these guys implode. So it's understanding what our expectations are, and then monitoring those expectations, which have been formulated by what the manager believes their risk to be, what their historical, what we get an assessment of, like we're investors in Millennium Partners. I used to work there twice, and just give you an example. Like we would not expect Millennium to have a down 15% month. You know what I mean? Like that would be just unusual. That would be out of the bounds of expectations. We have a certain set of expectations for each manager, and then it's a question of just monitoring the actual results versus the anticipated results or risk versus the market environment. And so it's kind of like taking a combination of those three factors, which is what are our expectations, which are derived from conversations with the manager, quantitative metrics of what their historical track record has been, qualitative assessment of what we believe their real risk is in terms of how bad liquidity can be or spreads and all that sort of stuff. So having a set of expectations and then monitoring that versus reality of what's happening versus what's going on in the market. So if the market goes down, and a guy is net short, and he loses money, that would be something that would be a flag, that kind of thing. So that's kind of, I'm probably saying a lot of different things because I didn't hear the whole panel, but that's kind of how the way that we look at risk. It's a lot of formulating expectations and then monitoring the actual results versus those expectations. And when they deviate, that's a reason for us to really dig into in much greater detail. Where did we misunderstand something? Where did we go wrong? Where did the manager go wrong? And that might be a reason why we would exit. We would exit a particular manager or fire a manager or a trader. Thank
you, Neil. Okay, so we're going to move on to the next topic here. And in a lot of quantitative managers especially, it's hard to know what an individual manager's methodology is, right? There's always proprietary intellectual property. You don't get to see their code. A lot of times, investors won't have the technological knowledge to really gauge how robust the code is, how robust the technical infrastructure is. So when you're designing risk management parameters on a manager like that, how do you design them? How do you factor in those unknown unknowns and operational risks? And my fire alarm keeps going off. Hopefully I don't burn alive. But Peter, you're on the ODD side of Booth Bay. How do you think about those kind of operational tail components in quant strategies?
Sure. So I think the less interesting answer, but the truth is that we haircut it a lot. And we frankly do a lot less in quant these days than we used to historically. And largely because of the reasons John was saying is the cost of entry for so many strategies to be successful is so high, the whole, whatever arms race, whatever analogy you want to use. So we're very skeptical, like our just to share, I think our portfolio's risk allocation to quant had been as high as 25 to 30%, call it 4 or 5 years ago. It's now under 8. And we think there's still great places in quant and systematic strategies. But it's a real challenge, I think, to really understand a persistent edge in a universe or kind of a sub strategy that has so many players with so many resources and smart people that you're going to find an edge that is persistent. So that's kind of our approach to quant in general. We still, I think we just allocated to a new quant manager last month. Like we're still doing quant, but just to, I guess, level set of how we think of the risk is that, and again, bringing it back to what John said is like, we don't want to be doing something that worked only in the rear view mirror and all of a sudden needing to predict if it's going to stop working, because we try to be, intellectually honest about what we know and don't know. And because of all the proprietary nature that you were talking about, James, we think we have good quant diligence skills, and we can ask certain questions and in a certain way that should tell us, if someone is really full of it or not, but and trying to connect dots. But that's really what it comes down to for us. And I could say there's some scientific things we do, but when it comes down to it, we try to really just, I'll switch to the operational angle, which you asked about, which is also really important. But that's our perspective, and part of that is just organizationally, like how we, as a strategy of where we've decided to devote resources, and so quant is an area that we think we know pretty well, and we know it well enough to know that you don't want to go into certain areas unless you're willing to really make big bets, kind of technologically and resource wise. And so, but operationally, exactly, that's the other thing is you need to have the ability to diligence and understand the manager's own kind of, EMS, if it's proprietary, and what, fail safes are there so they don't end in, a situation where they're buying high and selling low at a rapid clip. And so we try to get as close as we can at that level. And then obviously we work with our brokers, you know, the prime that they're going to be executing with, to understand their risk checks as well. And then monitor. And, you know, again, we think that there's a certain level of I would say frequency or you know, a certain level of volume where those things matter a lot more in terms of the amount of kind of open positions they may have. But again, we really, that takes us a long time to get comfortable with something like that. And that's a real minority of our portfolio because of it. But we've seen people like have those triggers caught and stopped and wind down trading. And it happens. So probably a long way of saying we think in a lot of quant strategies that we look at, because we tend to look mainly at managers, you know, sub $1 billion, sub 500 million. We think it's a very difficult space from a risk reward perspective.
Peter, that's awesome. Thank you. We've got a question from the audience here. I think it's geared for John. If you want to unmute, but Vasant says, great points about data. Vasant has some things to say about using old data more than a few years old. He thinks the problem is if you use data that is not representative or if it's too biased. Do you have any kind of like follow on to that? Like, you know, the old / biased data problem?
Yeah, I mean, I think we're probably on the same page. I mean, the most extreme or egregious example of this is taking a look at traditional trend followers that have 30-year track records and saying, oh my gosh, they have a Sharpe ratio of 1. It's senseless. So I mean, that's the most egregious example. But even as you go further into, you know, much more sophisticated strategies, I just think, you know, I watch the micro, you know, the market microstructure changing. I think the distribution of outcomes in all markets has changed. I think there's way more, markets are less robust and more fragile. And I think to look on any data, and this is all intraday, like if you go beyond intraday, you can make a case for the data is valuable, a little more valuable, but anything that's intraday, I think you're treading on really thin ice looking back any further than a year or so, 2 years, just because it's so dynamic. The market microstructure is so dynamic.
Yeah, I would echo that. I mean, it's really one of the whole reasons we started these forums, right? Is to get people to recognize that trend followers, you know, they show these 20, 30-year track records. They make money in 5, 10 years, right? You know, a lot of them have negative Sharpes or, you know, Sharpe compression into that 0.4 to 0.6 Sharpe range. And a lot of them have been resistant in cutting fees, right? So, I mean, like today, I look at trend almost like another beta you know, type strategy, and you know, maybe a little trend beta is useful in a portfolio, but I think that tactical type strategies that are, you know, maybe over a day holding period, but are doing something different, like the, you know, the relative value, the fundamental commodity, you know, short term but not HFT quant, like not sat arb, like some of the more unique managers that we've got presenting today. I do think those add a lot of value, and they do deliver the crisis alpha that Trend got credit for in 08, but really Trend just happened to be long bonds going into the crisis. And, you know, I just think if you look at the return drivers of Trend, okay, which means buying highs and hoping they go higher while selling lows and hoping they go lower, you know, moving average crossover strategies, by definition, that type of strategy is not going to give you crisis alpha. Okay, if you're going with the trend, you're not going to capture a stress event unless it's something like 08 where it's a very prolonged stress event. But since the microstructure has traded, since the proliferation of extremely fast algo strategies, trend's just too slow to keep up, you know, in my opinion. I mean, look at how quickly we went from all-time highs in equities to down 35%. Back to all-time highs again. I mean, markets move infinitely faster than they did 10 years ago. And I think investors would be wise to listen to John and, you know, look at, you know, 1, 2-year-old data, not these 10-year sample sizes. But Mark, what do you have to say about that?
Yeah, I think I broadly agree with a lot of the sentiment that's been shared, specifically how competitive the quantitative space is today. We do philosophically believe that what most managers are trading are betas. They're just factor-based approaches that are commoditized. Having said that, we still do find a lot of value in quantitative approaches. If we look at our macro book, it is pretty balanced across discretionary and systematic approaches. I would stress, though, that where we spend the bulk of our time in systematic trading is short-term. How we classify short-term is really delineated in two parts. I'd say, probably half of our exposure on the systematic side is intraday in nature, where we don't carry any overnight risk. And then the other side is really, max hold periods of 1 to 2 days. And really the reason we've congregated in that space is based on the prior comment I would have shared. If we do think that the vast majority of industry participants are trading in a similar way, we think its ability to forecast that is possible, then there's certain machine learning techniques that we think can get in front of these patterns and potentially be profitable. But we're under no illusions on how competitive it is, and working on our infrastructure, working with our traders as it relates to the strategies that they're running, they're constantly being evaluated and constantly being updated. To give you an example, this past year, we do have an intraday manager that has performed well, but it is an ongoing process as it relates to even with that specific trader working on continuing to refine the risk management techniques, because as the others have noted, the market continues to change and we need to be aware of how other people are congregating to profitable strategies, should they exist. But I don't think there is any one silver bullet. It's a combination of the infrastructure needing to be there, the research needing to be there on the alpha side, and then in totality, as it relates to execution, making sure that slippage is minimal as possible, our trading costs are as efficient as possible, and then ultimately, I think the qualitative side of what we're trying to do too is there should be a philosophical part of every manager that we have trading a systematic strategy for us, that we should think that fundamentally what they're trying to capture is different. We can verify whether that's true or not in the data, but I think there's so much diversification that you can rely upon based on your statistical analysis, but then fundamentally and qualitatively, more importantly, these things need to be trying to capture different opportunities because we know how competitive it is.
That's great. Thanks, Mark. And I just know that Neil has something very opinionated to say on this topic. So if you could unmute and give us some Barbadian opinionated quant microstructure commentary, love to hear it, Neil.
Yeah, sure. For us, it's all about, to put it politely, the demand supply equation between the sophisticated money versus the unsophisticated money or investors. Some people might say the smart money to dumb money equation. 25, 30 years ago, when I was involved, at Millennium, quant was a mainstay strategy. There were much fewer sophisticated people, managers like Millennium and Renaissance out there, and a massive amount of unsophisticated money. Today, that equation has completely changed, where the less sophisticated money has gone to more passive indexation and ETF type products. And so you're left at a playing field where you've got robots trading against robots, or professional poker play. You're playing at the professional poker table, which is not a table I really want to be playing at. So to echo Peter's comments, we started exiting quant about 3 or 4 years ago. Our current exposure to quant is sub 5%. It's also probably the most difficult strategy for us to diligence, because if I'm being honest, at the end of the day, we're just betting on geniuses. That's it. If they showed me the code, every single trade they have on the planet, and I had the smartest guy I knew in my team or even outside my team, they would not be able to make heads or tails out of it. So if I'm being honest, I'm just saying, David Vogel of Voleridge, or, to give you an example, is, one of the world's, #1 predictive modeling experts in the world. His returns continue to be good in an otherwise crowded space. Got a little bit of money with him. But at the end of the day, quant is becoming an increasingly challenging space. And by the way, it can change on a dime. I don't know how much Renaissance's new other funds, non-medallion funds, suffer from this. But the edge or the inefficiency that a quant is exploiting and thinks they have the gold, the alternative data, whatever they have, the deep learning, all of a sudden one or two other sophisticated players arb that out, and the quant doesn't even realize that it's been arbed out. Somebody working at Google who's running the proprietary money for the founders of Google, found some edge and is arbitraging away. So long story short, we just don't think that quant, broadly speaking, is attractive at the moment, and may not be for the foreseeable horizon. So our allocations have gone down over the years. Now it's sub 5%, similar to what we're actually an investor of Boothbay, but similar to what Peter echoed. It's become a much more crowded space, and we're just trying to look for spaces that are softer playing fields. If I was playing poker, I'm trying to look to play at the table where the rookies are playing at, not where the pros are playing at. And the quant space is really, it's not even the pros, it's the robots, and I can't compete against the robots, so I think I'm echoing what a lot of the other panelists have said as well. And trend following, we haven't invested in trend following in 20 years. After John Murphy wrote Technical Analysis of the Futures Market, and everybody understood trend following, and James, you're 100% correct. We've seen all the studies. The vast majority, if not all of it, all of the trend followers' returns can be explained by the fixed income component, where providing the crisis alpha is just a function of being long bonds during declines in the equity market, and with 10-year bunds trading at minus 50 basis points. Even if we didn't have a crisis, I'm not sure how much interest rates could fall even further from here, because if in the next crisis, and the implicit comment here is that you're investing in trend followers for crisis alpha. I'm not so sure that's even true today. If you were a trend follower, trend trading Tesla, you'd probably be up a fortune. We're all sort of there are some trends. It's just maybe we have to look at trend following in a different way. If you're basically broadly long the equity markets, you've had a great run for since 2009. So there has been some great trends. But if you're looking at it from a crisis alpha perspective, you're 100% right in that it's been explained by being long bonds when stocks go down. And again, I'm not in the prediction business, but I think there is a possibility that if there is a crisis that comes up in the future, which there will be, of course, at some point, it's going to be a liquidity-driven crisis where liquidity is going one way. And so it's not inconceivable that when you have liquidity coming out of the market, which you could argue is driving all of these markets today to higher and higher prices, whether it's equities, bonds, Bitcoin, whatever it is, it's a liquidity-driven market. If liquidity reverses, all of these markets reverse at the same time, and you could have a situation where interest rates go, where bonds sell off, stocks sell off, cryptos sell off, everything sells off because it's a reversal of liquidity. So anyway, again, echoing a lot of what you guys have said, but and maybe that means we should all be contrarians and go the other way. But the only thing I would say about trend following is you want to look at it differently today. Somebody who's been a trend follower, trend following the electronic vehicle market has probably done a fortune. We're thinking about it in terms of trend following currencies or fixed income or large indices, but there have been some interesting trends in some of the more micro aspects of the world.
Yeah, completely agree. Unfortunately, we're out of time. I just want to touch 2 points, Ramil, real quick. I think the other component of trend, which we haven't seen in over 11 years, was also interest rate driven, but easing and tightening cycles back when we had that, when interest rates, short-term interest rates would go up and go down. I think that really trickled down into everything the trend followers played, in equities, bonds, commodities, and that return driver has just been gone in this modern economy of nonstop stimulus, and easing.